Good evening and welcome back to the latest edition of InvestTalk Market Analysis for the week ending August 11th, 2023. Thank you all for tuning in to this channel and liking and subscribing to our podcast, InvestTalk. I'm host Justin Klein, and today I am going to title the video, Duration Risk Brings Shades of 2022 Back to Markets. And that's really the trend as of late, which I'll dig into the charts. But I want to talk a bit about inflation. Inflation data came in this week, and it was kind of a nothing burger. Here is core consumer prices. That was the same rate month over month from June in July, and so year over year you saw a modest deceleration because there's just the base effect uh, that's happening there. On the broad index without stripping out food and energy, that was also roughly flat, 0.18 to 0.17 month over month, but it did accelerate. Once again, base effects are different, a little bit different than between what you're looking at, but you can see that reaccelerating a bit, but still kind of right around that 3% mark. Now that was on Thursday. Today, core producer price index that did accelerate from a negative in June to a positive in July. Year over year continues to see a deceleration, small, but right there around 2.4%. And there's a lag here. Usually the producer prices feed in to consumer prices. You can see that in March, producer prices peaked at 9.7, and the consumer prices peaked in June, right? So peak in March versus peak in June. So roughly a 3-month lag there. So let me just see where this heads. And I actually think this is obviously more important to follow since it is leading. And so overall, you continue to see a more disinflationary environment. We still think there's secular inflation, but cyclical disinflation happening, and that's going to put less pressure on the Fed to hike. And you can see here, there's about an 88% chance that in September, a little over a month from now, September 20th, that they are likely to pause. But by December, there's a 60% chance that they will have no rate hikes, 8% chance there will be one cut, and about a 30% chance they'll raise one time. So it's still kind of leaning on, hey, they might raise one, but obviously those probabilities continue to decline. A month ago, it was 32% that it would be at 50, another hike from here. So consumer sentiment that came in flat, but still at the highest level since early last year. Actually, you could say all the way back to late 2021. So that was the economic data. Those there wasn't a whole lot besides the inflation side. You obviously have earnings coming out, which is mildly disappointing overall. But most importantly is what's happening in the treasury market. You have the massive amount of issuance in the back half of this year for new treasuries. And the big question is, are they going to go longer duration, shorter duration, et cetera? And so far, this is certainly impacting the long end of the curve. And you can see the 10-year starting to, pull back to the 20-day and is bouncing right off of it. So this is now clearly in an uptrend. Since the fall, we were in a series of lower highs, lower lows on the 10-year treasury, and that has clearly broken out to the upside. Even if you draw like a downtrend line here, right? This would probably be the best fit downtrend line. And it broke out, it retested, and it's having a continuation. So it looks to us that duration risk is rearing its ugly head again, and that is feeding through to the growth side of the market. As we know, higher interest rates, duration risk rearing its ugly head means the growth side is rolling over. Here's the weekly chart, and the daily chart is clear, right? This was, I talked about this for the last 2 months now. You had loss of momentum in June and kind of a follow through loss of momentum in July. You have the MACD continue to roll over, and now you're getting a follow through in the month of August. We are heading into Option X week next week, so that is likely to mean more volatility. And I think we're going to see some volatility through probably September, here into September. You're seeing that with the VIX. It did pull back today, but you had a surge up, and this is overall bullish consolidation. We'll see if we'll make a higher low. That's likely what's going to happen, and then move higher into September. Now, does that mean that everything's going to go to hell in a handbasket? No, not necessarily. Here's industrials, modest pullback up today. Right, here's the S&P today, down 5 basis points, but industrials were up. Let's look at energy. That was up. Just the value side of the market up, up a little bit. Even financials up a little bit. So it's really the tech side of the market. Here's SMH down pretty nicely. This is semiconductors usually leads the tech sector overall, and here's tech just continuing to pull back. Your Googles of the world. That was down slightly today, but it's the riskier names, like the Teslas. That was down. Let's look at Netflix. Netflix down another $6 today, and then the ARK Fund. ARK Fund just continues to roll over. Probably did some near-term support, so would not shock me to see a small rally early next week before we get through option X. So certainly on the watch for that choppy period, but probably a controlled pullback through the month of September. That's at least our outlook. Doesn't mean everything's once again going to hell in a handbasket. There's still opportunities out there, but this is a time where that rally that was led by tech is starting to wane, and obviously that's a bigger part of the indices, and so that's going to weigh on the broad indices. The move index, the volatility of the bond market, that seems fine. Still around 112, nothing to write home about there. The commodity index, this was just consolidation here, and it's actually acting pretty strong considering the dollar. The dollar reached the highest levels since early July and threatening a breakout. So that'll be interesting to see if that does or we fail from here. Energy, here's the USO, that continues to be strong. The UNG had a nice bump up this week, but a modest pullback. Let's go here. Yeah, so nice bump up on Monday, closed up pretty nice. Let's go to a weekly chart. From a low, and looks like it wants to have some more upside. Let's take a look at the broad indices, NYSE, and that is pulling back, but still above all the major moving averages, the 50-day, et cetera. So I think this is a period of more rotation than some huge risk-off event. We'll see. We'll certainly see. You can see that in the credit markets. Here's SIYG. That's just a modest pullback. Once again, hanging in there. There's no credit event happening at the moment, even with commercial mortgage-backed securities. Sorry, just get this. There we go. That is remaining strong. Look at this, falling through the upside, so no credit event on that side. The banking index, that also is hanging in there as well, although I don't love it kind of in the medium term, but right now it continues to hold up. The GDX really giving a nice day today on a negative news, right up over right about over 1% on the day, on some good earnings out of some of the names, and this is pretty crucial support, but so far it's definitely held in. If you look at GLD, this is just a pullback period. Nothing too crazy. It wanted to break out earlier in the year on a true Fed pivot. We didn't get that. We got a couple more rate hikes, but if that odds of a Fed hike come completely off the table by year end, that certainly be beneficial to the precious metal market, and the market likely start pricing in a cut in rates sometime next year. Silver to gold, still in a choppy period, neutral overall. What else do I want to get to? Transportation, maybe? Yeah, it's pulling back, but nothing crazy. The economy is holding in there, but certainly weakening. You see that with the jobs numbers remaining kind of roughly below 200,000 for most months of this year, and that just tells you that the jobs market is weakening and will probably precipitate a mild recession in the fourth quarter of this year, maybe first quarter of next year, where we start. But the market's going to front run that, and they'll get ahead of that. But overall, I would say near term bearish and medium term modestly bullish. I think we'll still get a good fourth quarter, but the third quarter looks to be a choppy period at minimum consolidation, modest pullback. Do we get to the 4,300 on the S&P? I think that's certainly probable. Do we get to 4,200? That's certainly possible. And I think those are the two targets on the S&P that you have to watch for in the coming weeks. And I think it's still time to pick up opportunities on that pullback. I don't think this is the time to go to a ton of cash and batten down the hatchets for some sort of 30-40% pullback. From the high, we're already down, let's see, from 4,600, and now we're at 44 and change. You're talking about a 4% pullback so far in that range. Do we get to 8 to 10%? That's certainly possible and is normal for most markets. So don't be shocked to see that type of that move. And this is more, once again, a rotation most likely than some sort of start of a continuation of the downturn from last year. All right. Now, I think that's it. Appreciate you all tuning in. I want to remind you the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a good night.